January of 2020, the month before the money supply started surging, the month before the pandemic hit, the billionaire's wealth as a percent of GDP in the United States was 14.1%. The money supply got goosed. Asset prices went up then. Land prices went up, real estate went up, stock market went up. Well, who owns the assets? Rich people do. Middle class people don't own many assets, and poor people don't own any. If they look at your balance sheet, it'd be negative net worth, not positive. And now, as a result of the non-neutral monetary policy effects, the billionaires in the United States, their wealth is 21.7% of GDP. It went from 14.1 as a percent of GDP, the billionaires' wealth, to 21.7%. So we've had a huge income inequality and redistribution in the economy.
You're watching CapitalCosm. My name is Danny. It is July 17th, 2025, and my guest today is Dr. Steve Hanke. Steve, thank you so much for coming on the show, my friend.
Great to be with you.
All right, well, let's just dive right in here, Steve. So many things to talk about, but I will open the stage to you. I'll let you set the tempo here. Given all that's transpired, what do you think should be front and center on the radar screen of investors? What's taking up the majority of your focus right now?
Well, one thing that popped up on the radar screen is my attribution has been changed slightly. There's been an addition, in addition to being a professor at Johns Hopkins University, where I've been around for 56 years. I've recently become a distinguished senior scholar at the Mises Institute.
Wow.
Down in Auburn, Alabama, home of the Austrian Economics School in the United States. So that's new news.
Congratulations.
So, thank you. At any rate, what's my take on what's going on? Well, that's a little bit hard to get your head around, in the sense that you've got so much smoke and so many mirrors in Washington, D.C., and they're changing almost by the hour, that it's really difficult to track things. And there's a lot of zigging and zagging going on, let's put it that way. But as far as the market goes, what's interesting to me is that I'm talking about the stock market now, not commodity markets or foreign exchange, but the stock market. If it's raining out and the weather is bad, the market goes up, and if it's sunny and the weather's just perfect, the market's going up. No matter what's happening, the market's going up, and it's reached very significant bubble territory, according to my bubble detector. All-time high in terms of bubble territory. So the problem with that is that means the market is overpriced, overhyped, and all the rest of it. And you're definitely in a overvaluation kind of bubble situation. But you never know when a bubble's going to pop, or whether it's going to pop, or whether the air will just slowly come out of the thing, and we'll get more reasonable valuations over a long period of time. So we don't know, but it's very expensive.
Do we have any data or anything to suggest that this market could be being propped up by either the Treasury or the Fed? Could the Fed be adding on assets onto their balance sheets, propping up the market? Anything that you've seen on that side?
No.
All right. Well, speaking of the Fed,
I think we're just in kind of a little bit of a speculative frenzy in a way. And you pick this up in many different ways. One is looking at cryptocurrencies. Now, cryptocurrencies are a highly speculative asset, and something like Bitcoin, which has made new highs this week, is not only a speculative asset, but it's one that has really no fundamental value whatsoever. So that leads you to the conclusion that there's a lot of speculative juices that are floating around, and you get that when no matter what the news is, whatever the asset that's being speculated in just goes up. It in other words, basically the shorts are nowhere to be found when you get in this kind of environment. Everybody wants to just double down and go up. So that's the general scene, shall we say.
Yes, and when you speak of the Fed, there's this ongoing rivalry or feud between the Fed and the White House. President Trump is signaling that he wants as much as 300 basis points cut from the Fed funds rate. Chairman Powell appears to be resistant to that notion, holding rates steady. What's your take on this this feud that we've seen ongoing? What would a 300 basis point cut do to the markets, to the economy, et cetera? And then vice versa, can we maintain rates at this level, considering we still have to finance any debt that's rolling over, any sovereign debt that's rolling over at this 4.55% level? A lot of the debt was originally financed at around 0% short term, as we can recall under Janet Yellen. So a lot to unpack there. So what are your thoughts?
Well, the first thing, coming just to the last technical point, I mean, Trump wants this, 3 percentage point reduction in the Fed funds rate, and he claims by doing that we would save, I can't, over 300 billion, I think, in per year in finance costs. But there's a little problem with that. There's a big difference between what Trump says and what reality is. And reality is that the Fed doesn't borrow at the Fed funds rate. That's a spot rate. The average duration of the Treasury securities outstanding is like 6.5 years, something like that. So the Fed funds rate in a way is irrelevant, and the numbers that he tossed out are really bogus. So that's one point. The second but larger thing is this flap between Trump and Chairman Powell, and both of them I would receive Fs if they were in my class. And the reason for that is that they're both focused on interest rates. And monetary policy is not about interest rates, it's about changes in the money supply. So they're both just fundamentally completely wrong, looking at the wrong thing. Now, a little bit more detail on Chairman Powell. I think he's one of the worst Fed chairmen that we've ever had. We remember it was with him during COVID that the money supply shot up to a record rate of growth, actually. M2, that measured the money supply, was at its peak, all-time peak, by the way, since the Fed was founded in 1913. It's never been higher than a little over 18% per year. That was the peak. And of course, following that goose in the money supply, we had a surge in inflation. And you knew this was going to happen if you embraced, as John Greenwood and I do, the quantity theory of money. And Greenwood and I wrote in the Wall Street Journal that given the increase in the money supply, inflation could go up to 9%. Well, it went up to 9.1%. So we got that right because we used the right theory. Changes in the money supply with a lag affect economic activity. In short, they affect nominal GDP, which contains a real and an inflation component. So and the Fed didn't get that right at all. And during this whole period of time, we had Chairman Powell testifying that he didn't think the money supply had a reliable changes in the money supply had a reliable relationship to economic activity. He basically trashed the quantity theory of money and the idea that somehow money has an effect on inflation and real economic activity and asset prices and all those things that it does have an effect on. And then finally hitting the panic button after the inflation peaked out, they hit the brakes, actually threw the Fed into reverse and started contracting the money supply. So we've only had significant contractions in the money supply 4 times in history since the Fed was founded in 1913. So 2 dramatic events, roller coaster ride, up and then down. That's Powell, and no recognition of the quantity theory of money, and only a complete focus on Fed funds rates. Now, so that the grade's F. Now, what about the president? Well, the president is even more simple-minded, and he's only talking about the Fed funds rate, period. So he's got all that wrong too, and that's why I think in this case I'm for Chairman Powell to staying put.
I see. Well, you mentioned the money supply, obviously being the primary.
Then you basically got 2 midgets fighting with each other, and I think you just don't get into big brouhaha where you're changing guard in an unusual way, and by the way, that would really hurt whoever comes in as the next chairman of the Fed, because they'd have no credibility whatsoever. I mean, they basically would just be bagmen for the president, and I don't think that's a good thing.
And Powell's term expires in 2026, correct?
Yes.
Right. And then
he's got a few months to go, so just ride out the storm and take all of Trump's insults and threats and so forth, but stay put.
Gotcha. Now, in regards to money supply, we have been seeing the money supply tick back up. You mentioned that we saw a reduction in money supply one of the few times throughout U.S. history since we've seen reduction in money supply a few years back. It has been retracing back up. It's back at an all-time high here. Is this any signal? Is this a warning sign as to things to come? Could this have been the warning sign of speculative boom that we're seeing today?
Well, not really, because the money supply is growing at 4.5% per year. If you measure it by M2, which is the broadest measure that the Fed publishes, and that's an anemic rate of growth. It has gone from negative contraction to a positive rate of growth, but the rate of growth is anemic. And when I say anemic, the Hanke's golden growth rate, using the quantity theory of money, that would allow for the Fed to hit its inflation target on a sustained basis, inflation target of 2%, is 6.3%. So it's growing. As I say, it's anemic. It's increasing slowly, but it's still anemic. And I think what they should be, what they should do, we talked about the Fed funds rate and interest rates. What they should be doing is focusing on something that would actually have an impact on the growth rate in the money supply, and the Fed would directly controls that. And that is they should stop quantitative tightening. There's still quantitative tightening, shrinking the balance sheet of the Federal Reserve. So, and I think they should have stopped that a long time ago, and we would have seen more rapid rate of growth, maybe something coming up to around 6%, which would be fine with me.
Are you tired of mainstream media noise and looking for real insight into what's actually going on in the world and where things are headed to next? Then you've got to check out Gerald Celente's Trends Journal, the publication that's been ahead of the curve for decades, forecasting economic shifts, geopolitical risks, market trends, and so much more. Right now, by clicking the link below and using promo code CapitalCosm, you'll get 10% off your subscription. And get this, an annual subscription to the Trends Journal comes out to just $2.59 a week. That's $2.59 a week. That's less than your daily coffee for news and analysis that could help you protect and grow your wealth. Don't wait to find out what happens after it happens. Stay ahead of the trends with Gerald Celente's Trends Journal. Click the link below and use promo code CapitalCosm to get started today. I see. Now let's go ahead and shift over to tariff policy. So I know you were a big voice on that. We did get the numbers for June, and it appears for the first time in a very long time, I believe in 20 plus years, that the U.S. was in a surplus for the month. I believe it was a $27 billion surplus. Is what they're attributing it mostly to the tariffs, but I want to get your thoughts on the matter here, Steve.
Well, yeah, the tariffs have brought in revenue. You had one of the front page articles in the Financial Times today indicating how much revenue had been brought in, and Trump is, and the Secretary of Treasury Bessent have been advertising the tariffs as a great way to raise revenue. They're raising revenue. Well, the tariffs are a tax, and they are raising revenue with it. But it's probably the most distortionary, worst way. If you wanted to raise revenue, I couldn't think of a worse way to do it than tariffs. But the spin in Washington will be, oh, this is just great. We told you we were going to raise a lot of revenue with tariffs, and we are raising revenue, and it's just wonderful for the fiscal position of the United States to be, strong arming Tom, Dick, and Harry, and by the way, who's paying that? Americans. Americans pay for the tariffs. The idea that the myth that somehow foreigners pay is ridiculous. When the goods or services flow into the United States, it's the recipient of those goods and services in the United States that pays the tariff. So the initial transfer of money from those who have the tariff imposed on them and the U.S. government, it's all U.S. It doesn't involve foreigners.
Is that why it makes tariffs a bad way to generate revenue, or is there some other reason that you're kind of alluding to?
The main thing is it interferes directly with voluntary exchange between buyers and sellers, and it eliminates the gains from trade. The old line, there are gains from trade. Well, what does that mean? That means if Danny's selling Hanke something, Danny wouldn't sell it unless Danny was benefiting from the sale, and Hanke wouldn't buy it unless he was benefiting from paying Danny and purchasing whatever Danny was selling to Hanke. But what happens with a tariff goes in between Danny and Hanke and taxes that transaction and eliminates some of the gains from trade. Danny won't get as much, Hanke won't get as much, and the revenue goes where? It goes to the U.S. Treasury. So it couldn't be worse in an economic sense, in a fundamental kind of, shall we say, economic 101 sense. It's a complete disaster and stupidity. However, there are other costs, and all these tariff threats and tariffs that are being imposed by Trump he's making a lot of enemies for the United States. You think the Canadians are in love with the United States now? No way. I mean, tourism has really dropped off tremendously. The Canadians, the snowbirds, aren't coming to the United States because they're so annoyed at Trump and his tariffs and tariff threats. And you go right around that. Now we have tariff threats being secondary tariffs, they call them. It's actually they're like secondary sanctions, because tariffs are in the same family as sanctions against Russia. And the secondary tariffs are, well, if Russia doesn't come to some peace agreement or ceasefire, what have you, in Ukraine, it's not quite clear what Trump wants them to do within 50 days. But if they don't do whatever he has in mind in 50 days, he's going to impose secondary tariffs of 100% on countries that purchase goods from Russia. Well, that's mainly who? It's mainly China and India, because they purchase oil. So you think that's making a friend in China and Beijing? You think that's making a friend in Delhi? No way. I mean, they can't stand the guy. And by definition and implication, the Americans, Uncle Sam, he's giving Uncle Sam a bad reputation.
It certainly does seem that he's further dividing. He's in a way, he's kind of creating the conditions more so for a multipolar world, right? Because he was elected to push America first and bring back American exceptionalism, but it's actually the opposite. And you've heard this from a number of his officials, including Rubio and J.D. Vance, who say something along the lines of that we are entering a multipolar world. And sure enough, the policies seem to be pushing us that way more so, whether that's intentional or not. It certainly speaks to the multipolarity that's forming. Now, again, going back to the tariffs, you and I were just talking off camera about the CPI and the PPI. It doesn't appear that the tariffs have worked their way into the PPI yet. The CPI being consumer price index, PPI being the producer price index. Why do you think that is? Why do you think prices are still relatively subdued versus expectations?
Well, the main thing comes back to what happened to the money supply 2 years ago, 2.5 years ago. It was contracting, and that contraction. Remember, inflation is always a monetary phenomenon. Now, if you put tariffs on, that is not that's not a monetary phenomenon, obviously, and it doesn't change inflation or the course of inflation, but it does change relative prices, because those things that have tariffs whacked in there on top of them, those things will go up in price relative to other goods and services. But that doesn't necessarily mean that the overall price index will change. And again, the spin out of Washington last Sunday on CNBC, Trump's top economic advisor, Kevin Hassett, said that the CPI, this was before the new report came out, but he said the CPI was at its lowest level in a decade, which is just it's just spin. I mean, it wasn't true. It's not even factually true, but that's how they talk. So the public gets so confused by what's going on, and the journalists will report that. People read the news, think that's what's happened, or they're probably scratching their heads. They say, what do you mean? The price index is as low as it's been in a decade. When I go to the grocery store, eggs are certainly not at the lowest price they've been in a decade, or the car I'm buying, or house, or whatever it is. It just doesn't ring true. So it's a credibility problem. It's Hassett, the top economic guy in the White House. He's become little more than a spinmeister. He'd rattle stuff off. If you hear that in these interviews, he's like a machine gun, this, that, and the other thing. But people just stop paying attention.
Yeah, it's a definite misinterpretation of what the CPI actually is, right? Because the CPI is just measuring growth, not the actual uh, or the CPI number that's reported, the year over year number, that's what's measuring growth. But it's not that it's coming down;
Well,
it's just it's decelerating.
well, yeah, it's an index number, and the index is an index of like 300 goods and services that
Mm-hmm.
are in there, and so in a way it's a basket of goods and services, and it's the index of the price of what's in the basket, all the things that are in the basket. So and indexes are always tricky to construct and so forth. There are a lot of price indices, by the way. There are many. We're talking about two that are very known, but there are many price indices and ways to measure what's going
Can
on
you
with
can you look at
prices.
can you look at the gold price as a proxy for an inflation index as well?
Well, in a way, I mean, there is a correlation between all the. I mean, in a way, it's a different thermometer.
Mm.
It's not an index, but it's a different thermometer. All these price indices include lots of things and lots of different weights and so forth. But gold definitely is something that on gold, by the way, gold is it's something that I pay attention to. There's something
You're
called
good.
the the Hanke Kofnes gold sentiment measure, and Abe Kofnes and I actually measure sentiment in the market every hour, and we do that with text mining. Every article that comes up on the internet that has anything to do with gold, we're able through text mining to determine whether the article is bullish or bearish on gold,
Mm.
and we put that together to come up with basically an index of what's going on with the sentiment in the gold market. Is it bullish now? Is it bearish now? And it's using very high frequency data every hour. We're the only ones that know how to do this and do it. It's interesting from a trading point of view because if you have extreme measures in the sentiment, if you go extremely bullish again over a short period of time, you will find that extreme bullish measure backs off and reverts back to something towards neutral or maybe even bearish. So if you're trading, you want to know what the sentiment is and that it might revert. And if it's extremely bullish and you've got a long position, you better liquidate. If you're trading on again high frequency, you would be liquidating that long position and maybe going short. And if you're on the other side, of course, it's just the other reversal. If it's very bearish, you would want to be putting on a long position or taking off your short position. So that's one way to answer your question. Do I in the real world, do I pay attention to gold? Yeah, I pay a lot of attention to gold every hour. What's the sentiment in the market?
And how's it looking now? I mean, it appears to have gotten some confirmation to its current bull run due to the fact that the white metals are now moving. Silver and platinum have both been moving. Is this fair to assume that this is kind of like a confirmatory move on the part of the precious metals when you start seeing the more riskier? You go further out onto the risk curve and start seeing some of the other metals start to
Well,
move in
yeah,
tandem with gold.
yeah, but not you switch from very short term high frequency sentiment, the Hanke Kofnes gold sentiment score. That's very high frequency and the
Mhm.
duration's very short. You're talking about something that's much longer. you're talking about sentiment that's months long kind of thing,
Gotcha.
and that has happened, and it what you articulated, the kind of narrative that you articulated is true. I mean, it's just those are the facts. I mean, you're not Danny, you're not spinning anything. You're just saying that's what it looks like, and you know, and by the way, one thing we do know about prices is they are objective. I mean, we have subjective valuations of things. What you think something's worth, what I think it's worth, what some other analyst. Those are all subjective views, and they come into the market, and once they come into the market and people have skin in the game, and whether they're bulls or bears, they all come into the market, and eventually there's a price discovery occurs, and a price appears, and that price is not subjective; it's objective. It's sucking in all the subjective views about things in the process of coming up with a price discovery process, and bingo, you get a price, and that is objectively right now what gold's worth, platinum, copper, whatever stocks. You can't argue with that. It's just a fact. So what you just said is a summary of kind of the objective data and what's going on.
So what's next for gold with all this in view?
I remain a long-term bull. It's going up.
All right. Nice and sweet. Short and sweet. Anything else you want to talk about here, Steve? Anything else you want to talk about here before we wrap up? I think we've covered pretty much everything.
Yeah, I think the one thing I would like to mention is that a couple of things. One is that when you have a purely speculative asset like cryptos, they basically suck savings out of the economy and kind of sterilize the savings. It's like if you buy a piece of fine art, you have to pay, you have to save, you have to accumulate some savings. You buy the art. It can be for speculation or just the joy of it all. But the fact is, those savings that are put into cryptos, for example, don't become intermediated through investment banks, and those savings don't go as a result into productive investments in the economy. So that's an economic effect of having these big groups of speculative assets. It's like, think about all the savings that would be required going into Vegas, for example. So that's one point. The second point I would like to make is that on May 6th, Matt Sekurki and I wrote a book, Making Money Work, and on May 6th it was released by Wiley, and that book turns around this view held by Trump and Chairman Powell that interest rates are how monetary policy is formed. We go back to the quantity theory of money and put that on the front burner, and no, monetary policy is all about changes in the money supply. Point number one. And changes in the money supply occur because of what? Policies that affect not only the central bank, but commercial banks, because commercial banks actually produce about 80% of broad money measured by M2 in the United States and in most other countries. It's the commercial banks who actually produce the money when they make a loan. When they make a loan to Danny for a bankable project, Danny's got a business he's starting or something. A bank evaluates the likelihood that that business is going to produce surplus, so Danny's going to be able to pay off the loan. Danny, of course, has to put up assets as collateral to get the loan, but that bankable project is what's behind the curtain, so to speak. And when Danny receives the loan, what happens? His checking account goes up. And and where does the bank get the money? Well, it just produces it out of thin air. And but once the bank account of Danny goes up, the bank accounts are counted as part of the money supply. You've got firepower when your checking account goes up. It's like handing you cash. You can spend the money that's in there. So that's why the second point we raise in the book is getting commercial banks back at the center of everything in the money and banking system and the financial system. So that's our second point. And then the third big point is that monetary policy, of course, you want to keep inflation low and stable. That's one. And you want to keep the economy growing and productivity growing. But also, you want to make monetary policy in such a way that it's as neutral as possible and doesn't have uneven effects on sectors in the economy or individual classes of people in the economy. Now, one bad thing that occurred in the run-up after COVID, the run-up in the money supply, is that in January of 2020, the month before the money supply started surging, the month before the pandemic hit, the billionaires' wealth as a percent of GDP in the United States was 14.1%. The money supply got goosed. Asset prices went up then. Land prices went up. Real estate went up. Stock market went up. Well, who owns the assets? Rich people do. Middle-class people don't own many assets, and poor people don't own any. If they look at your balance sheet, it'd be negative net worth, not positive. And now, as a result of the non-neutral monetary policy effects, the billionaires in the United States, their wealth is 21.7% of GDP. It went from 14.1 as a percent of GDP, the billionaires' wealth, to 21.7%. So we've had a huge income inequality and redistribution in the economy due to the fact that the Fed wasn't practicing what Sakurki and I advocate and demonstrate in our new book, Making Money Work, which you can put that up. I mean, it's on sale at Amazon, many other places. But so that's kind of the broad framework of that book. But the neutrality of money is something people don't talk about at all. But the Fed should be paying, and the policymakers making monetary policy should be thinking very seriously about neutrality. Neutrality among the big sectors in the economy. Don't distort the activity in various sectors due to the kind of monetary policy that you have, or the uneven monetary policy that you have had with COVID, made the rich really very rich relative to everybody else.
And it seems
this run up in inflation that we had, it benefited the very rich, and it hurt the poor. The poor saw their real wages. Guys getting a weekly wage saw their wage adjusted for inflation go down, actually, not up.
Yeah. And you're starting to see these signs start to pick back up again. I mean, I collect collectible trading cards, and that market is white hot right now, similar to what happened in the COVID era. I don't know if that's a sign of things to come, but it's very interesting. You start seeing these collectibles, artwork start to get a bid as well. Could you look at this as an early warning sign for a repeat of the previous inflation cycle that we had a few years back?
Well, No, not the inflation cycle, because that's determined by what's going on with the money supply, and
Hmm.
it's anemic. It's not that's not a problem. But what it does show is back to what we were talking about earlier, and the trading card thing is interesting because let's face it, it's a highly speculative asset, and it shows you that the speculative frenzy, it's going into all these markets now, whether it's crypto, whether it's the stock market, whether it's trading cards or other collectibles, which I'm not following. I mean, but I'm glad
Hmm.
you brought that up because it illustrates to me that there's a speculative frenzy in the air right now, and that's curious to me because as I look at things, I see a lot of risk and uncertainty in the picture, and that would mean that you would be risk off. You wouldn't risk on. You and I are saying is that it looks to us like we're seeing the signs of risk on, not risk
Hmm.
off. And
Yeah.
but I look at the real world, I see a lot of things that would make me be want to be risk off, like the fact that the stock market clearly is in bubble territory. At least given my objective measures, it's in bubble territory. So I'd want to be hunkering down. I'd want to be risk off. And with what's going on in Washington D.C. these days, I certainly would want to be risk off. I wouldn't want to be risk on.
I see. Well, can't think of a better way to cap things off than with that, Steve. Thank you so much for coming on. Where can people find you if they want to hear and see more of your work?
You can follow me on X at Steve_Hanke, and right now there are about 805,000 satisfied customers, I guess,
Hmm.
because they're following me.
That's pretty good. Well, I mean, I don't know if we'll get you above that 1 million mark with this video, but you're getting
Yeah,
close to
yeah,
it. You're getting
yeah,
close.
yeah. Yeah, let's, yeah, let's do a shout out, and peddle the thing a little bit. Why not? It's
Yeah,
all about
guys,
marketing.
go to X and follow Steve Hanke on Twitter. So I will have the link to his. Sorry, go to X and follow him on Twitter. Go to X and follow him there. We'll have the link to his X account down below in the description box, as well as the pinned comment. Steve, thank you so much for coming on. We'll also have the links to your
Great.
books as well for people that are interested
Okay,
too. Guys,
great to be with you, Danny. Have a good
yep,
day.
yep. Likewise, like the video if you enjoyed this podcast, and write "Go Steve Go" in the comment section if you agreed with our analysis. If you disagreed with anything, that's fine too. But let me know why you disagreed, what you disagreed on. I do, in fact, read the comments. Subscribe to the channel so you don't miss an episode, and I will catch you later.